Good morning and welcome to the Moneycontrol live stream. You are watching Markets with Santo and CJ. A brand new week awaits us, but it seems like market is all set for a twitchy start, even though we have got a boost, some sort of a boost from the government in terms of the cut on excise duty on retail fuel. If you look at the Nifty futures on the Singapore exchange, they are suggesting a muted to weak start for local stocks. But all of this is still, we have to still see whether the market reacts very positively to the Saturday's move of cutting the excise duty, right, Santo? And so, Santo, I actually want to understand from you, this move, of course, comes at a very, very opportune time, given the way inflation has been taking hold across the economy, across our consumer, hurting a lot of consumers from the top to the bottom. But do you really think this is going to douse the fire of inflation?
Very, very difficult, and the government is in some kind of a catch-22 position. You know, whatever it does, things are likely to go against it. So what does it do? You know, it does nothing, in which case inflation continues to rise. Now it has tried to do something, but it too has come at a cost. So the decision to, give subsidy on, cut excise duty on fuel, give additional fertilizer subsidy, all means that you are looking at extra 2.15 trillion, in by way of either foregone revenue or additional burden on your balance sheet. Now, where will this money come from? It will have to borrow.
Corporates, they will be the one paying the direct taxes,
so when you're taking that kind of a revenue hit, probably you're hoping that it will be offset somewhere else. But given that, it looks like, the economy will be in a slow lane for some time, that's not going to happen. And where do you get the extra money from? You go and borrow it. When you borrow it, what do you end up doing? You end up pushing up interest rates higher. So the government is in a spot, not a enviable situation to be in right now.
Yeah, not even for the RBI, I think it will not be an enviable situation, given that it is the debt manager for the government. But for me, the bigger concern coming out of this, and I told you even earlier that given the way prices were rising, it was very likely the government would probably see some of its subsidy bill go up. And now the concern is, what does this have, what impact will it have on the capex side of the story, right? Because let's not forget that the entire FY23 budget, even last year's budget, were all about infrastructure spending, all about capacity formation, right? But at this point of time, Barclays is expecting that fiscal deficit will definitely overshoot the 6.4% target for FY23. It might come around the 6.9% space. So therefore, government's purse strings will probably anyway be hit. Also, it is expecting that capex could come down by as much as 1 trillion rupees or 1 lakh crore, which could be a sentiment dampener for the overall capex story that has been building up in the stock market for the past 2 years.
Well, and look at other factors too. The whole global economy right now, is in the midst of a slowdown. You got weakness in global markets now. Nasdaq, 8 successive weeks of losses. This the first time this happened since 2001. Right? And the Dow, that too, 8
it's
weeks
ugly,
of, it's happening for the first time since 1923, according to Anuj.
Yeah, but Santo, on the economic front, at least there is some cause for optimism. If you look at what the words that are coming out from the World Economic Forum, there is a suggestion, although the fear is that, of course, the possible slowdown in the US and Chinese economy could end up hurting the emerging markets. But it seems the popular opinion is that India probably will not be part of that basket. India will probably be able to outgrow or at least outperform a lot of its emerging market players. If you look at what the finance minister had to say last week, she was very confident that India will grow upwards of 8% in terms of GDP this year, even though the RBI and other economists are very cautious on that front. So I think it still remains to be seen. It's too early to, suggest that probably we are headed definitely in the slow lane along with high inflation. There is still cause for optimism.
Well, CJ, that's the story we like to tell ourselves. Whatever happens to the world, India is going to be an oasis of calm. We'll grow better.
Said it. We are the oasis.
Yeah, we are the oasis. But then look at past trends. That's not necessarily been the case, because when the global economy as a whole doesn't do well, we are integrated with the rest of the world. CJ, there's no escaping that. So if there isn't enough money flowing into emerging markets, we're bound to get hit.
I think we will know in another 3 months where we stand in terms of economic growth and whether we are heading towards a slowdown just a year after we actually started seeing some recovery in the economy. That said, now let's quickly dive into some of the stocks action that probably will be buzzing in today's trade. Starting off with Santo.
Shree Cement, the first stock on our watch list. Now, fourth quarter numbers, below what market was expecting, and now the main reason for the squeeze on margins was continuing rise in input costs. Now, that's been a story not just for Shree Cements; it's been the case for just about all cement companies. Now, Shree Cement is among one of the premium plays in the cement space, and in the stock also saw a good run up. But now that the cement story as a whole is coming under question, I think this stock too is likely to underperform. So I would be cautious on Shree Cement.
Yeah, I've got to give it to you, Santo. Things are not really looking pretty for Shree Cement. I mean, the only thing that actually used to make it an outperformer in the cement industry was A, of course, it was gaining market share along with Ultratech from the likes of ACC and Ambuja, and B, its cost structure was always so superior, right? And now it is ending up losing a lot of that superiority. So there is not really much to be very optimistic, especially in light of new competition coming in, a very aggressive player coming into the cement industry. So probably one stock that even I am very likely to skirt off, but one stock that I would rather be bullish on and where I am optimistic on is Paytm,
right? That is a stock we love to disagree on. Okay.
You would love to disagree, but I love to agree on the fact that this company is starting to show some signs of stability and some signs of getting its act together.
We have been talking about that for many months now.
No? I mean, you look at the Q4 numbers, very strong revenue and contribution margins came in for the March quarter. Goldman Sachs was of the opinion that the company is steadily showing signs of monetizing a lot of its user base, which runs into millions, of course. If you look at the adjusted operating profit, which is basically adjusted for the stock option that it gives to its employees, that has also, those losses have also come down significantly on a quarter-on-quarter basis as well as on a year-on-year basis. They had earlier in April come out and said that they achieve break even or profitability adjusted of ESOP cost, of course, by September 2023, and they have retained that guidance. So there is no change there. That should also give some confidence to investors. And the fact that the stock has corrected 70% odd, even more than that from its IPO price of 2,150 rupees. I feel that the risk reward are now tilted in favor of those who wants to be bullish on the stock. Goldman Sachs also has retained a buy target on the stock, and it remains optimistic that possibly a turnaround is just around the corner.
Well, investors in Paytm, they've been, waiting for that kind of signs of turnaround, and every little.
And they were there.
It's almost like clutching at straws.
See, come on, it's not like that.
September, 2023 is quite some way off, right? And given the way overall market sentiment has changed for the worse, it looks very doubtful that investors would want to go in for companies where there is very low earnings visibility. Also, I would rather go with Macquarie on Paytm, because the stock price has been in fact underperforming quite a bit, and Macquarie has got its call, right? Now, Macquarie's main argument is that the whole financial services business, the scalability of the model is under question. And if you look at the average loan size, it's very small, somewhere around 5,000 rupees. Besides, the core business model, what does it really stand for? There's questions on that also, and then not to mention the sustained underperformance in prices. So I think this is a story I wouldn't touch in this market.
Santo, you talk about core business, right? There are three core businesses. One is payments, the second is financial services, basically largely lending and the stockbroking side of the business, and third is cloud and commerce, which is basically ticketing and sales. Now, cloud and commerce was largely impacted by the pandemic, and that is coming back on its own, even though sequentially there was a little moderation on revenues because, of course, the October-December quarter is generally more favorable for that business because of the heavy festive season activity. But even then, if on a year-on-year basis, that business has seen a lot of improvement. When you talk about ticket sizes in the financial services, I don't think Paytm is trying to become the next Bajaj Finance in terms of selling out or giving out loans in the range of 5 lakh rupees per user or 10 lakh rupees per user.
But then how will it make money if you continuously make smaller loans?
So actually, if you look at Paytm, they are actually earning higher margins on their financial services than they are earning on their payments or the commerce, right? So for them, if volumes grow, that is all that the play is. And their volumes have been growing, their disbursements have been growing substantially. If they can sustain the current run rate of about 1,500 to 2,000 odd crore rupees that they saw in disbursement in March, they could hit a loan book of more than 1 lakh crore in terms of distribution, right? And if you are doubling your margins on those sort of loans, then that's the story that the monetization part that Goldman Sachs will also refer to. So therefore, I would still not be so sure to give up on Paytm so soon. In fact, probably 6 months ago, it made sense to be skeptical on the stock given how overvalued it was. But 6 months hence, 70% now given up of its value. There is a possibility that the turnaround story will start, and it depends on how consistently Paytm can perform.
Well, the next stock is Adani Wilmar. Lot of volatility in this stock over the last couple of months. It rose to about 800 plus and then fell back very sharply, and now it started climbing again.
You're so gleeful about it, I know.
No,
you were warning the world against it, that this is what happens.
No, there's nothing about gleeful really, CJ. We just we observe and we remark on
okay.
that. That's what we do. Now the stock is again has rebounded very strongly, but given the way it has been volatile, I think it clearly merits caution. Now, till about the company, till the time it reported its fourth quarter numbers, the general feeling that the performance would be quite strong. But as the fourth quarter numbers showed, there is room for disappointment. Also, it doesn't necessarily mean that being in the best business doesn't necessarily mean that you can that actually translates into your numbers, earnings numbers as well. We saw that in Q4 already, and some of the risks that have been flagged by analysts on Adani Wilmar is that high volatility in its raw material costs, and also the fact that a lot of hopes that are being built on the scaling up of the packaged food business, that may somehow not materialize. But even if these were to click, what is the price ultimately that you're willing to pay for a stock like that? It's richly valued. So even ICICI Securities, which is bullish on the stock, has actually put out a hold rating on Adani Wilmar, saying that valuations leave very little room for upsides.
Santo, I think ICICI Security, for starters at least, is a few weeks late on getting out that point of view. I agree that the Q4 earnings were quite lukewarm compared to the expectations that were built up in terms of the stock price performance that we saw. I mean, the stock doubled probably from its IPO price within a matter of weeks after listing. That said, if you look at the fundamental side of the business, right? See, in the markets, price movement can be one thing, and fundamentals can definitely be detached from that. Sometimes prices
that's what we are happening most of the time for the last 2 years.
Exactly. Yeah. So, but if you look at the fundamental story, and if you are somebody who wants to be in Adani Wilmar for the next 12 months, maybe 18 months, you look at the fundamental side of the story, and the story still remains quite intact. They are gaining market share in the edible side of the business. They are trying to de-risk their portfolio from the edible side, given that edible oils, is a very cyclical, can be a very cyclical business, and therefore they are investing heavily on the food business in order to of course, de-risk their portfolio, and of course because you're selling value-added products, you tend to make better margins on that side of the business. Apart from that, if you look at from a valuation point of view also, the stock has corrected 25% from its 52-week high. I mean, with a 25% sort of correction, the stock now in a bear market, those who want to add the stock to their portfolio probably from a 12 to 18 months point of view will start giving it a relook, even if they were discouraged during the when it was high flying, probably one of the best stocks in the market in 2022. So for me, I take your point that yes, maybe the Q4 earnings might have dampened sentiment, but if you take the longer picture in point of view, I think this is still a good bet to be in.
But it just went from being very, very expensive to probably just very expensive or still expensive.
You're living in India, sir. Consumer stories are always either very expensive, or nose bleeding expensive, right? That said, one stock that probably will be in action, will probably remain a favorite to investors, is Sarda Energy. Impressive Q4 performance for the March quarter, which probably will make the stock even more attractive, given if you take into account its trailing PE of about 4 times its earnings. Q4 net profit rose about 49% on a year-on-year basis, while sales jumped more than 50% on a year-on-year basis. Overall, the profitability of the company has also improved if you look at it from a year-on-year basis, and it's been a very, very good year FY22 in terms of steady earnings performance. And the HNI interest in the stock has been continuously rising if you look at that, and the trailing valuation also remained quite attractive. So this is one stock that I will really watch out for.
Well, in the meantime, market has opened. The Nifty has opened about 26 points higher.
Mildly positive start, Santo.
Nifty Bank is up in a big way, close to about 200 points, and the strength in mid-cap index also, that's up about 0.65%. And among the big gainers, you have Maruti Suzuki, which is up close to about 3%.
Yeah, probably that. I think auto stocks will probably remain quite active today, given that the cut in excise duty would probably ease the the burden of owning a vehicle at this point of time. The cost of ownership, which has been such a big debate in the auto industry, that will probably ease a little. I believe PSU banks will also be doing quite well, because you would expect the government bond yields to cool off a little bit, and that will at least ease some of the the losses that they have been taking on mark-to-market basis on the treasury side of the business. So PSU bank stocks could be one to watch out for today in today's session.
So, well, on Sarda Energy, CJ,
yeah,
how do you see this excise higher duty, export duty, which the government has levied on
pellets?
Pellets, how is that going to
affect?
I
think this is probably going to be a little bit of a dampener in terms of business side, given that the export side of the business has been doing quite well. But I still expect that the domestic side of the business will do the heavy lifting for Sarda Energy going forward. Sarda Energy, Godavari Ispat, they have all benefited a lot from the import duties that have been imposed on iron ore pellets, while exports were allowed to thrive. Although this 15% duty that has been imposed will probably be a little bit of dampener in the near term. But overall, if you look at the earnings trajectory entire FY22, it seems very positive. And this is one company that is on the mend and trying to improve itself quarter by quarter. So I will still not doubt the longer term story.
Well, I'll take your word on that,
Thank
CJ.
you.
Container Corporation, fourth quarter numbers in line with what market was expecting. But the big sentiment dampener at this point is that the company has revised its capital expenditure and about 800 to 1,000 crores between now and FY26. That's leading some section of the market to kind of be a little jittery. However, analysts tracking the stock have pointed out that about 600 kilometer of the Delhi freight corridor is now operational, and higher volumes from that probably should help Container Corporation. Besides, Nomura is also bullish on the stock, although it has cut its price target to about 785 rupees. It says that the management has guided for good volume growth and should be able to deliver on that.
Well, Santo, business aside, PSU stocks are all about what the government is going to do, right? And Concor was one of those big divestment stories that was, brought out back in 2019, 2020. And still now, till now, we have not seen any sort of movement on that sort of front, at least some tangible movement on that front. And I think that will continue to remain an overhang on Concor, even if the company's guidance for FY23 was quite optimistic and quite strong, and analyst community in specific quite liked it. But I feel that the overhang of the divestment process still in limbo, no clarity on that. Plus the lack of clarity on the land licensing fee with the railways. I mean, that has been a thorn on the side of the government as well as the company in terms of getting the stake sale process fast tracked. So I think those two issues definitely remain hanging over the stock, and it will continue to weigh on the performance. Apart from that, if you look at the technical charts, they are also indicating that the death cross has been formed.
You
the 50-day moving average is below the 200-day moving average, which is showing that there is still a lot of pain in the near term for this stock to come, and therefore for me this is not the place I want to be. There are better opportunities, as I mentioned, Paytm.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. I hope you enjoyed watching it, and please do share your comments on the show in the comment section below.
And do follow us on the social media links that you can see at the bottom of your screen. We will catch you live at 3 p.m. with all the day's action. Till then, have a great trading session and take care.